At this stage in today's bull market, you've heard it plenty of times, dividend stocks are overvalued. But are they? Is one of the last safer places to find a yield a lost cause at current valuations? Well, Adam Aloisi walks us through what he thinks and why on today's show. Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we want to make the best investments that we can. So thank you so much for joining us. And as always, if you would like to have my detailed notes from today's show, if you're listening, you missed something, or you want a written record to look at later on, simply text the word family notes. That's one word, family notes, the number 44222, or visit investorinthefamily.com and sign up on the email list. We'll make sure to get you taken care of as well. Remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com, and you can subscribe to the podcast at iTunes and the Google Play Store. Do you like shopping for insurance? Of course you don't. It can be a terrible experience, especially when it comes to life insurance. If you have loved ones that you want to take care of financially after you're gone, then you may want to consider term life insurance, and Policy Genius is the easiest way to get insurance, period. At Policy Genius, you can figure out what you need, compare the top policies, get covered, and save. If you want to save on term life insurance, go to investorinthefamily.com/policygenius. That's investorinthefamily.com/policygenius for access created specifically for Investor in the Family listeners. I do get a small commission if you use my link, which costs you nothing. It's a win-win. Visit investorinthefamily.com/policygenius for more info and have the most enjoyable insurance shopping experience you've ever had. I hope you enjoyed today's interview with Adam Aloisi. Well, hey, Adam, welcome back to the show.
Brian, it's great to be back. Thanks for having me.
Yeah, honor to have you. We had a great time last time, and I'm really looking forward to today as well. And today, we talked about in advance, I really want to hear about these articles you've written in the last few weeks about dividend stocks, and especially as you've been looking into, are dividend stocks overvalued or just too expensive today? And so do you mind beginning by giving us a little bit of background, like a brief overview of what your thesis of those articles was?
Well, I think it's no mystery out there today that dividend stocks have been gravitated to collectively because of this low interest rate environment that we've been having. So, the critique is that there's a bubble that exists, that these stocks have the potential for a big sell-off going forward if any number of things happens, if interest rates start to go back up again, if we have a recession, if people just wake up and say, I'm paying too much for these stocks. So I think the perception out there is that there's a lot of risk right now in terms of price destruction potential. Now, there's lots of different investors out there. Some care about price more than others. Some people are more worried about a durable income stream, and and then I guess I would put maybe retired investors in that category who are more concerned about seeing cash realization as opposed to total return potential. So they'll invest a bit differently. But I think the general fear out there is that the dividend stocks as a bunch are overvalued. So I've been kind of trying to focus and hone in on what should an investor do nowadays with their portfolios given that perception.
So what did you find?
Well, in my personal view, the ZIRP situation has created an environment where it's kind of sane for investors to be paying a little bit more for dividend-paying stocks, because when you go and look at all the investments that you could be making, CDs, money markets, bonds, things that are paying income out there, you can't get anything from a bank anymore. So there's really somewhat of an opportunity cost having your money sitting in cash, earning nothing when you could be earning a 3-4% return on a dividend stock. So, in my view, now, when you go into the equity realm, generally speaking, you're taking more risk because equity prices fluctuate. You have no guarantee return of your capital as you do with FDIC insurance and cash, or contractual obligations and insurance associated with corporate or municipal debt. So you're taking more risk. So there's a trade-off that you're generating more income by going to equity income, but you are also taking a bit more risk. So each investor has to look at themselves in the mirror and say, how much more risk am I willing to take to generate some more income in this environment? And there's no single blueprint or textbook article that you can read that will answer that, because we all have different situations. We all have different income needs. We have income coming from different sources. We live different lifestyles. So for me to say, give you an allocation blueprint of, everybody has to be in 60% stocks, 20% bonds, and 10% otherwise, and 10% cash, that type of mentality, which I think was kind of old school, just really does not work today. And so, I think there's rationality in having more money in stocks today than in previous years because of ZIRP, but you have to understand what the risks are if you're going there. And so I don't know that I've come to any conclusion, because I don't pretend to know what's going to happen 5-10 years down the line. I'd be much more bullish if valuations were lower than what they are, but I think the market to some extent is factoring all of this in, and that's why it's more difficult to buy, or more expensive to buy, a dividend stock today than it would have been 15 years ago when interest rates were much higher.
So when you were studying dividend stocks, did you look at all companies paying dividends and lump them in one big group, or did you pick a few key ones? How did you approach that?
I will typically look at large cap stuff, but I will look at just about anything. There's thousands of stocks out there, so you can't look at everything. It's good to have a cross section of looking at different things. Most of my readers on Seeking Alpha are more interested in large cap stocks than small cap stocks. I think there's merit to both. In general, it's much more comfortable to be investing in a company that you've heard of, that you know what their business model is, what they sell. You may or may not use the products. That doesn't necessarily make it a better investment. However, it may make you sleep well at night, but if you don't know all the ins and outs of it, you could be in for a bad surprise down the line. So, I think that investors should be looking at everything, and I look at everything, trying to find value, trying to find opportunity, and sometimes it comes in strange places, although, when you start looking at smaller cap stocks with capitalizations under $1 billion that you may have never heard of, and you have to really put time and effort into understanding the business along with its financials and so forth, it can become rather time consuming. So, in general, you're going to find, I think, the do-it-yourself investor is probably going to be honing in on large cap stocks, because it, in my opinion anyway, it seems to have a simpler proposition behind it. However, for someone that's really trying to build a good, solid portfolio, I think it's good to have some of these larger cap stocks and some of your smaller mid-cap names that can provide some greater returns down the line as well.
Yeah, and that's helpful. And one of the things I was curious about is, as you're trying to determine whether or not dividend stocks as a whole were overvalued or appropriately valued, I didn't know if maybe you looked at a basket of companies to determine that, or if you were individually looking at a couple of different companies and kind of assume those were representative of the whole when you're writing your articles as far as whether or not dividend stocks are overvalued.
Well, you have to. I mean, the valuation is a very complicated, in my view, anyway, is a very complicated endeavor. I mean, some people will strictly look at price to earnings and say, well, that has a PE of less than 15, or it has a PE of 11. Well, it must be cheap compared to a stock that has a PE of 18 to 20 or above. In my opinion, that's far too simplistic. Terms like cheap for a reason come to mind immediately. That just because something looks cheap there may be a reason for it. It's not growing. They've got a problem. They have a lot of debt on the balance sheet. The sector, you're in the energy sector, and things are just kind of difficult. So, it's difficult to, paint a wide brush all over this. You need to be, you need to look at every individual stock as an individual entity, and say to yourself, well, if I'm, this company's growing upper single digits a year, or 10% a year, and I think it can continue to do so, it may make sense to pay a bigger price to earnings multiple relative to a company that's selling at 10, but their revenue year over year went down, or they're an oil company and they're not making as much profit anymore, or their dividend looks like it might be in jeopardy. So you need to understand things like payout ratio and cash flow versus net income. What do these things mean? Because they all kind of come into play with all this. So I don't think there's any real way of just looking at a basket of stocks. I think in general, we see prices going up faster than what their earnings are, which is what we've seen probably for, since we exited the financial crisis, which is why, in general, people think are expensive today. Now, I think you can find value out there still. But I don't think it's as easy as it was 5 years ago. Things are growing maybe the same, but their price multiple is now higher. Does that mean you shouldn't buy it? Well, maybe not. None of us has a crystal ball. If the earnings continue to flow through, the market may continue to give it a premium multiple. But things are getting punished nowadays, as we've seen in energy and other sectors where businesses are not performing well. So, it's. I guess I'm forgetting what your question was specifically. It's kind of difficult to put an easy fingerprint on all of this. You have to take a lot into consideration and really put a lot of due diligence into deciding whether you should pay up for something nowadays or not.
Yeah, I think part of it was trying to get a feel for what was the scope of your as you're investigating your thesis about whether or not dividend stocks are generally overvalued or maybe at a healthy place right now. Just curious what scope of dividend companies you looked at when you're trying to answer that question for yourself. And so that's why I asked if you looked at a big basket, or maybe there are a few individual large caps that you kind of dug deep into and saw to see where they stand. And so that's kind of what I was getting at.
Well, I think I kind of covered it.
Yeah, you did. Yeah,
kind of a general cross section of companies, and so there was no specific methodology behind it all.
Right. Well, in that, do you feel like you found any particular good opportunities when you're investigating those companies?
Yeah, I'm finding things all the time that I find interesting. Maybe for myself as someone who's willing to take a higher level of risk. Some things have worked out near term for me. Some things have flatlined, and just like anybody else, I have my share of losers also.
Sure.
I think I consider myself kind of a go anywhere investor, that I will look for whatever I think fits my mold and the type of investor I am. It just seems to make sense at the time. Every investor is going to have a different, and this is one of the most important things in investing before you start, or even while you are. You need to know yourself. What is your risk tolerance? How much can you afford to lose? How much income do you need to generate? If you're not asking yourself these types of questions, or you're not investing appropriately in line with what your risk tolerance is and what your goals are, you're bound to have a problem down the line. You may become more of a trader. You get into something and say, well, maybe I shouldn't have done that, and you sell right away, or something spooks you. And if you're doing a lot of that, and you think that you're an investor, you don't have the right strategy in place. I'd like to think as I've gotten older, I've become a little bit more patient with things. And, if I get into something and it goes down by 5%, I'm not going to be at the computer the next day going to sell. I may even say, well, I'm going to put more money into it now because I think it's cheaper, and my thesis for having bought the stock hasn't changed.
Do you mind sharing any of those? You said you did find some opportunities that you liked for yourself after doing your research. Do you mind sharing some of those specifics, or is that premium level stuff?
I'm trying to remember. I'm looking at some of the articles I wrote here. Recently there was a company called Daktronics, which is a company that makes scoreboards, digital scoreboards and information boards. It might be at an arena you've gone to recently for a sporting event, or outside your school as you drive by. The stock was getting beaten down. I saw it as cheap as this is a very small cap stock. I think maybe $400 million market cap. Had a dividend in the 4% range. It was trading at 6%. I went into that. They had a good earnings report. It wasn't as bad as what people are anticipating. They had a good backlog in business, and it went from 6 to 9. In a couple of days. So, if you're looking for a price appreciation, that type of thing exists out there. I think you need to be a little bit contrarian minded and willing, as I said earlier, to go and look at some things that you're not familiar with. Was not really familiar with that business altogether. I spent some time on it. Thought that it looked like it was oversold near term, and it had a nice pop. Now, that's not going to happen all the time. I also got into a company called CF Industries, which is involved in nitrogen-related fertilizers. That whole space has been really beaten down. They have a dividend in the 5% range. I bought it about that level. It popped up 10%, and now it's back to about where I bought it. So, but my thesis is that over time, fertilizer prices are probably going to start to pop up a little bit because we're always going to need fertilizers. People need to eat, some of those secular themes. But, when you get into the commodity space, there's a lot of risk, as people have found out with energy over the years, that, oil was at $100, went down to 30. I don't think a lot of people were anticipating that. So a lot of retired investors, dividend growth investors, had a lot of your Exxon, Chevrons, and Conocos in their portfolio, and they've taken kind of a dive, although they've kind of popped up a little bit near term. So there's a lot of risk out there, and you need to realize that when you go kind of looking at some not so household name stocks, and that's not comfortable for everybody, and it's not for everybody. So again, you need to know yourself and say, can I go take some chances on some companies that I don't really know that well? Am I the type of investor who's comfortable enough to look at some of this stuff, or should I just be in an index fund and really not invest at all independently in stocks and just say I will take what the market gives me?
Wonderful. Well, Adam, this has been a great look at overview as far as dividend stocks and their valuations, and I appreciate your work on Seeking Alpha on these articles, as well as the overview you've given us here in this podcast today.
All right, Brian, it's always a pleasure being with you.
Well, hope you enjoyed today's interview with Adam Aloisi. Remember, you can get full show notes with links and other details at investinthefamily.com. Don't forget to subscribe at iTunes, Stitcher, or the Google Play Store. And if you want to receive my detailed summary sheets of today's show for reference later on, simply text the word Family Notes. That's one word, Family Notes, the number 44222. Or simply visit investinthefamily.com and sign up, and we'll make sure to get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.